I want you to open a browser tab right now and look up the current balance of your 401k account. Go ahead. I will wait. Look at that number. Really look at it. Because that number represents years of your life. It represents the Saturday mornings you worked when you could have been somewhere else. It represents the vacations you shortened, and the cars you drove a few extra years, and the raises you directed into contributions instead of spending. That number is not just a financial figure. It is a measurement of discipline and sacrifice and deferred gratification across years or decades of your working life. And I need to tell you something about that number that your 401k provider, your plan administrator, your employer's HR department, and the mutual fund companies whose products sit inside your account have a powerful financial incentive never to explain to you clearly. That number is being drained. Right now, today. Not in a dramatic market crash that you can see and react to. Not in a single catastrophic event that makes the news and prompts a response. Quietly, invisibly. Through 4 specific mechanisms that operate inside your 401k every single day, regardless of what the market is doing, regardless of whether you are contributing or not contributing, regardless of how carefully you selected your investment options during your last open enrollment. 4 silent killers that are collectively removing a significant and measurable percentage of your retirement wealth every single year, compounding the damage over a 20 or 30-year period into a loss that, when you finally calculate it clearly, will be one of the most shocking numbers you have ever seen in your financial life. This is Retire Right America. And today we are going to name all 4 of these silent killers, show you exactly how each one operates mechanically, put a dollar figure on what each one costs the typical American household over a full retirement savings career, and give you the specific actions that neutralize each one before it takes another year of your retirement wealth. Let me give you a person. His name is Thomas. Thomas is 52 years old. He works as a regional sales manager for a mid-sized consumer products company in Indianapolis, Indiana. Thomas has been contributing to his company's 401k plan since he was 28 years old. He has contributed consistently, increased his contribution rate several times over the years, and always taken the full employer match. His current 401k balance is $480,000. Thomas feels good about that number. He has been responsible. He has been consistent. He plans to retire at 65, which gives him 13 more years of contributions and growth. Thomas has never looked at his plan's fee disclosure document, has never analyzed the expense ratios of the funds in his portfolio, has never thought about the tax structure of his contributions in the context of his expected retirement tax rate, has never considered the impact of his plan's investment menu limitations, and has never modeled what his $480,000 balance would be today if the 4 silent killers I am about to describe had not been operating on his account for the last 24 years. I'm going to show Thomas, and every person watching this video who has a 401k, exactly what those 4 killers have already taken from his account, what they will take over the next 13 years if he does nothing, and what specific moves he can make starting this week to stop the bleeding. Because the money that has already been taken by these 4 mechanisms is gone. Thomas cannot get it back. But the money that will be taken over the next 13 years is still his, if he acts before the killers take it. The first silent killer is investment expense ratios, and I want to spend real time on this one because the way it is presented by the financial industry makes it sound trivial when it is actually devastating at scale. An expense ratio is the annual fee that a mutual fund or ETF charges for managing the fund. It is expressed as a percentage of your assets, and it is charged automatically, taken directly from the fund's returns before the return is reported to you. So it is invisible in the sense that you never write a check for it, and it never appears as a deduction on your statement. It just reduces your return quietly every year. The average expense ratio of actively managed mutual funds, which are the type of fund that dominates most corporate 401k investment menus, runs between 0.5 and 1.5% annually. The expense ratio of a low-cost index fund from a provider like Vanguard or Fidelity runs between 0.01 and 0.05% annually. That difference, which sounds like a fraction of a fraction, is one of the most powerful wealth-destroying forces in the American retirement system when compounded over a 20 to 30-year savings career. Let me show you the math with Thomas specifically. Thomas has $480,000 in his 401k. Assume a gross market return of 7% annually over the next 13 years. If Thomas is invested in actively managed funds with an average expense ratio of 1%, his net return after fees is 6%. At 6% for 13 years, his $480,000 grows to approximately $1,020,000. If Thomas moves to index funds with an average expense ratio of 0.05%, his net return is 6.95%. At 6.95% for 13 years, his $480,000 grows to approximately $1,130,000. The difference is approximately $110,000, generated entirely by the expense ratio difference. No additional contributions, no change in market performance, no change in asset allocation, just the elimination of the fee drag that the actively managed funds were imposing on Thomas's returns every single year without appearing anywhere as a line item on his statement. And here's the additional dimension of this that most people miss entirely. The actively managed funds that charge higher fees do not, on average, produce higher returns than low-cost index funds. Decades of academic research and real-world performance data consistently show that the majority of actively managed funds underperform their benchmark index over 10-year and 20-year periods after fees. Thomas is paying $110,000 over 13 years for a product that is statistically likely to underperform the cheaper alternative. The fix is straightforward. Log into your 401k account. Find the fund performance and expense ratio information, which your plan is legally required to provide in the fee disclosure document. Identify the lowest cost index fund options available in your plan menu, typically a total market index fund, an S&P 500 index fund, and an international index fund. Move your existing balance and redirect future contributions to those low-cost options. The $110,000 difference in Thomas's case took about 30 minutes to capture. The second silent killer is the plan administrative fee, which is a completely separate charge from the fund expense ratios, and which most 401k participants have never noticed because it is buried in the fee disclosure documentation that almost nobody reads. Plan administrative fees cover the cost of operating the 401k plan itself, including record-keeping, compliance, legal services, participant services, and the plan administrator's profit margin. These fees are typically charged in one of three ways: as a flat annual dollar amount per participant, as a percentage of assets in the plan, or as a combination of both. For smaller employer plans, particularly plans with fewer than 200 participants, administrative fees can run between 0.5% and 1.5% of assets annually, on top of the investment expense ratios we already discussed. For Thomas, if his plan charges a 1% annual administrative fee, on top of an average 1% fund expense ratio, his total fee drag is 2% per year. At a gross return of 7% with a 2% total fee load, Thomas's net return drops to 5%. At 5% for 13 years, his $480,000 grows to approximately $910,000. Compare that to the $1,130,000 he would have with a low-cost index fund structure and minimal administrative fees. The additional administrative fee cost, on top of the fund expense drag, is another $220,000 over 13 years. Combined, the two fee layers cost Thomas approximately $330,000 over the remaining accumulation phase of his retirement savings career. Thomas did not know this fee existed because it was disclosed in a document he received during open enrollment that he filed without reading. The protection is to request and actually read your plan's fee disclosure document, which your employer is required to provide annually under Department of Labor regulations. Identify what administrative fees are being charged and how. If your plan's total fee load, combining investment expenses and administrative fees, exceeds 1% annually, it is worth having a conversation with your employer's HR or benefits department about whether lower-cost plan options are available. Many employers have switched to lower-cost plan administrators and fund lineups in recent years, specifically because participant awareness of fee disclosure requirements has increased. Your employer has a fiduciary obligation to act in plan participants' interests regarding fees. That obligation is your leverage. The third silent killer operates not on the investment side of your 401k, but on the tax side. And it is the silent killer that the financial industry is most reluctant to discuss, because addressing it requires redirecting contributions away from the traditional pre-tax product that generates assets under management for the plan providers. The third silent killer is the deferred tax liability that is building inside your traditional pre-tax 401k account alongside your balance. As we covered in detail in a recent Retire Right America video on this topic, every dollar in a traditional pre-tax retirement account is not fully your dollar. It is your dollar plus the government's claim, stored together in a single account, displayed as a single balance, with the government's portion invisible until you start making withdrawals. For Thomas, at a combined federal and state effective tax rate on retirement distributions of approximately 28 to 32%, his $480,000 balance represents roughly $330,000 to $345,000 of after-tax wealth, and approximately $135,000 to $150,000 of deferred tax liability that will be collected by the federal and state governments over the course of his retirement distributions. The balance is not $480,000 of his money. It is approximately $340,000 of his money and $140,000 of the government's money, stored together and growing together, with the government's share growing proportionally as the account grows. The silent kill happens when the RMD begins at age 73, and the government starts determining the withdrawal schedule rather than Thomas. The forced distributions stack on top of Social Security, push more Social Security income into the taxable tier, potentially trigger IRMA Medicare surcharges, and all of this happens at the single filer rate if Thomas's spouse predeceases him, hitting a tax rate that is structurally higher than the married filing jointly rate he pays today. The fix is the Roth contribution election and the systematic Roth conversion strategy that removes pre-tax dollars from the account, pays the tax now at the current controlled rate, and converts the future withdrawals from taxable ordinary income to permanently tax-free distributions. Every dollar Thomas moves from traditional to Roth is a dollar that will never again be subject to RMDs, provisional income calculations, IRMAA exposure, or the single filer bracket collapse that hits surviving spouses. Thomas's employer plan offers a Roth 401k option. He has never elected it because nobody explained what the election actually means in dollars over his retirement lifetime. The fourth silent killer is the one that operates most quietly and that most financial professionals consider outside the scope of a 401k conversation, even though it directly determines how much of the 401k balance Thomas will actually be able to spend. The fourth silent killer is the absence of a coordinated withdrawal strategy, specifically the absence of a plan for which accounts to draw from, in which sequence, and in what amounts during retirement that minimizes the lifetime tax burden on the total portfolio and maximizes the after-tax income available to Thomas for as long as he lives. Most retirees draw down their accounts in the most intuitive sequence, which is also the most tax-inefficient sequence. They spend their taxable brokerage account first because it feels most accessible. They preserve the 401k because it is growing tax-deferred and feels like the most protected asset. And they treat the Roth IRA, if they have one, as the account of last resort because it is the most protected from taxes and they want to keep it intact as long as possible. This intuitive sequence is almost exactly backwards from the optimal tax sequence for the majority of retirees. The correct sequence, which varies somewhat depending on individual circumstances, but follows a general principle that holds across most retirement scenarios, is to draw from the traditional pre-tax accounts strategically during the early retirement years, before Social Security begins and before RMDs become mandatory, converting portions to Roth during these lower income years to reduce the future RMD burden, then to begin Social Security strategically at the age that maximizes lifetime benefits, then to draw from taxable accounts in a way that manages capital gains recognition, and to preserve the Roth account as the last resort because it generates no RMDs, no provisional income, and no IRMAA exposure on withdrawals. The financial value of optimizing the withdrawal sequence, rather than drawing down accounts in the intuitive order, has been estimated by multiple academic studies at between $100,000 and $200,000 in additional after-tax lifetime income for a typical middle-class retiree household with accounts spread across traditional, Roth, and taxable structures. Thomas does not have a withdrawal sequence plan. He has a contribution strategy and a general investment allocation. But the back end of the retirement income picture, the part that determines how much of the accumulated balance actually translates into spendable retirement income, has never been addressed because the plan provider's financial interest ends at the accumulation phase. I want to show you the cumulative impact of all four silent killers on Thomas's specific situation, because the individual numbers are significant, but the combined number is the one that changes how you think about your 401k permanently. The expense ratio drag over 13 years cost Thomas approximately $110,000 in foregone growth. The administrative fee drag costs approximately another $220,000 in combined fee impact. The deferred tax liability represents approximately $140,000 of the current balance that belongs to the government rather than to Thomas. And the absence of a withdrawal sequence strategy will cost Thomas an estimated $150,000 in avoidable taxes over a 20-year retirement distribution period. The combined impact of all four silent killers on Thomas's 401k situation is somewhere between $550,000 and $620,000 in lost retirement wealth on a $480,000 account. The silent killers will cost Thomas more than the account is currently worth if he does nothing to address them. That number, $550,000 to $600,000, is not a dramatic exaggeration designed to create alarm. It is the mathematically calculated result of four real mechanisms operating on a real account at realistic rates over a realistic timeline. The alarm is appropriate, the situation is real, and the moves that address it are available to Thomas right now, this week, before the killers take another year. This is what Retire Right America was built to show you. Not the comfortable version of retirement planning where every decision you made was fine and the only variable that matters is how much you saved. The complete version where the structure of the account, the fees embedded in the product, the tax liability building inside the balance, and the withdrawal strategy you never built all determine how much of the impressive number on your statement you will actually be able to spend. Go to the comment section right now and tell me the total expense ratio of the funds currently in your 401k. Tell me whether your plan offers a Roth 401k option and whether you have elected it. Tell me whether you have ever received and read your plan's fee disclosure document. And tell me whether you have a written withdrawal sequence strategy for retirement or whether you are planning to figure it out when you get there. From those answers, I can tell you which of the four silent killers is currently doing the most damage to your specific account and what your single most urgent first move is. Drop your information in the comments and we work through it together. Like this video if the cumulative $550,000 figure made you look at the balance on your statement differently than you did when you opened this video. Subscribe to Retire Right America and hit the notification bell so every financial survival guide we produce reaches you before another year of silent killer damage accumulates in an account you work too hard to fund. Share this with someone who has a 401k and has never looked at the expense ratio of a single fund in their portfolio. Because the silent killers are running on their account right now, and they have no idea. This is Retire Right America. Stay informed, stay protected, and do not let the silence cost you what you cannot afford to lose.